Good afternoon. Welcome to Kenya News Update today. I'm your host, and we're diving into a story that affects every Kenyan, from the price of fuel at the pump to the stability of our national economy. The global oil market is in a state of extreme volatility, and the epicenter is thousands of kilometers away in the Strait of Hormuz. Oil prices have extended their slide today as investors try to make sense of conflicting signals from Washington, Tehran, and global capitals. This is a 12-minute deep dive into what's happening, why it matters for Kenya, and what might come next. Our top story, Brent crude oil, the global benchmark, is trading at $87 per barrel this afternoon, a significant retreat from the $91 level it hit just yesterday. This comes after a truly staggering surge of 20% on Monday, March 9th, as the US-Israeli war with Iran intensified. That single-day jump was one of the largest in history, driven by fears that the conflict would choke off the world's most critical oil chokepoint. But the market is now pulling back, and the reason appears to be comments from US President Donald Trump. In a press conference yesterday, President Trump suggested, and I quote, "We have options on the table that don't involve a full blockade. The American Strategic Petroleum Reserve is the largest in the world." Investors are interpreting this as a signal that the US might orchestrate a massive, coordinated release of oil stocks to calm the market, rather than escalate military action to fully reopen the strait. Let's set the scene with some critical background. The Strait of Hormuz is a narrow waterway between Oman and Iran. It is, without exaggeration, the jugular vein of global oil supplies. Every single day, nearly 21 million barrels of oil pass through it. That represents about 21% of global petroleum liquid consumption and 31% of all crude oil traded by sea. For perspective, that's more than double Kenya's entire annual oil consumption, passing through a single, 39-kilometer-wide channel every single day. The war, sparked by US-Israeli strikes on Iranian nuclear facilities last month, has now spread. Iran has unleashed a new wave of attacks this week, targeting not only Israel but also Gulf nations, including a strike on a major Saudi oil field. The conflict has moved beyond shipping, creating what Amin Nasser, the CEO of Saudi Aramco, called a severe chain reaction and a drastic domino effect impacting aviation, agriculture, and global supply chains. So, why the sudden price drop amidst continued fighting? The answer lies in the potential for a historic market intervention. Reports are circulating that G7 leaders, who will meet by video conference later today, are weighing a proposed record release from strategic petroleum reserves. The numbers being discussed are unprecedented. Analysts at Goldman Sachs estimate a coordinated release could total between 60 million and 120 million barrels. To put that in Kenyan terms, 120 million barrels is enough to meet Kenya's total fuel needs for approximately 4.5 years. The mere possibility of this supply hitting the market is causing traders to sell, betting that the physical shortage fear has been overplayed. But let's not mistake a price drop for stability. The situation on the ground remains perilous. Visual evidence from the region underscores the risk. Satellite imagery shows increased naval activity. We have footage dated March 9, 2026, from the Biscaya Bay gas regasification plant in Ziabina, Spain. Why show a plant in Spain? Because it highlights the global ripple effects. Europe, fearing disruptions to pipeline gas, is scrambling to increase its LNG imports, diverting ships and driving up global gas prices, which in turn affects electricity generation costs worldwide. The war has already caused spiking energy costs, fuel rationing in several European and Asian nations, and even school closures due to transport fuel shortages. Now, let's bring this home to Kenya. The Energy and Petroleum Regulatory Authority, EPRA, announced its latest monthly review just this morning. The new prices, which take effect at midnight, are a mixed bag, reflecting the wild swings of the past 2 weeks. Super petrol increases by 8 shillings 50 cents per liter in Nairobi, now costing 212 shillings 50 cents. Diesel, however, sees a slight decrease of 2 shillings, landing at 198 shillings. Kerosene is up by 5 shillings 50 cents to 199 shillings. EPRA's statement cited the extreme volatility in the international market and the continued weakness of the Kenyan shilling, which is trading at 158 shillings to the US dollar. The government has maintained the petroleum subsidy, but at a reduced level, with the Petroleum Development Levy covering only 10% of the price stabilization cost this month, down from 15% last month. The economic implications for Kenya are profound. Energy is a primary input across our economy. Let's break down the impact sector by sector. First, transport. The Matatu Owners Association has already signaled a potential fare hike of between 8% and 10% if fuel prices remain at current levels. This directly hits the pocket of every commuting Kenyan. Second, agriculture. The cost of fertilizer, which is heavily dependent on natural gas, has skyrocketed. 50-kilogram bag of CAN fertilizer has jumped from 3,800 shillings in January to over 5,200 shillings today, an increase of nearly 37%. This threatens the upcoming long rains planting season and food security. Third, manufacturing. The Kenya Association of Manufacturers reports that energy costs now constitute 8.1% of total production costs, up from 6.5% just 6 months ago. This erodes competitiveness and could lead to job losses. We've gathered perspectives from key stakeholders. First, the government's view. Cabinet Secretary for Energy, Davis Churchier, spoke to us earlier. He stated, "The government is monitoring the situation hour by hour. Our strategic petroleum reserve in Mombasa currently holds 114 million liters, equivalent to 21 days of consumption. We are in active discussions with alternative suppliers from West Africa and are considering all options to cushion Kenyans." That's a critical number, 21 days of buffer. On the other side, we have the consumer's pain. Mary Ashno, a small-scale trader in Gikomba, told us, "I use kerosene for lighting in a small cooker. The price is now almost 200 shillings. My profit for the day is only 500. How do I choose between light, food, and school fees for my children?" The private sector is sounding alarms. The Kenya Private Sector Alliance, KEPSA, has called for an emergency economic stimulus package. Their CEO, Carol Kariuki, argued, "This is not just a fuel crisis, it is a systemic economic shock. We are seeing cost push inflation across the board. The central bank may be forced to raise interest rates to combat inflation, which would then stifle business investment and credit. It's a vicious cycle." Her point on inflation is crucial. Year-on-year inflation for February came in at 8.0%, already above the government's target band of 2.5% to 7.5%. Analysts fear the March figure, influenced by this oil spike, could breach 9.5%. What are the potential scenarios from here? We see three main paths. Scenario 1, de-escalation and reserve release. This is the market's current hope. The G7 announces a massive 100 million barrel release, President Trump brokers a temporary ceasefire, and shipping through the Strait gradually resumes. In this case, oil prices could fall back to around $80 per barrel, providing significant relief. Scenario 2, stalemate and sustained risk. The fighting continues at its current level, the Strait remains partially blocked, and the reserve release proves insufficient. Prices oscillate between $85 and $95, creating persistent inflationary pressure and forcing Kenya to dig deeper into its forex reserves to pay the import bill. Scenario 3, escalation and full closure. This is the nightmare scenario. A major incident, like the sinking of a tanker, leads to a complete closure of the Strait. Analysts at Citigroup estimate this could send oil prices to $150 per barrel or higher almost overnight. The global economy would likely tip into recession, and for an import-dependent nation like Kenya, the consequences would be severe, runaway inflation, a plummeting shilling, and potentially social unrest. Kenya's response must be multi-pronged. In the short term, maximizing the strategic reserve and enforcing price controls is essential. In the medium term, accelerating the transition to renewable energy is no longer just an environmental imperative, but an economic security one. The Lake Turkana wind power project is currently operating at 98% capacity, and the government fast-tracking solar and geothermal projects can provide a buffer. In the long term, this crisis underscores the urgent need for the proposed Kenya-Uganda oil pipeline and the development of our own Turkana oil fields to reduce import dependency. As we conclude, let's revisit the core numbers that define this crisis. The initial price surge, 20%. The current Brent price, $87. The potential G7 reserve release up to 120 million barrels. Kenya's fuel buffer, 21 days. The local price increase for petrol, 8 shillings 50 cents. The inflation threat, potentially 9.5%. These aren't abstract figures, they are the metrics of our collective economic anxiety. The coming 72 hours are critical. Watch for the G7 announcement. Watch for any movement in the Strait. And watch your pocket, because the decisions made in Washington, Brussels, and Tehran will echo on the streets of Nairobi, Mombasa, and Kisumu. This is a stark reminder that in our interconnected world, a conflict in a distant strait can dictate the price of a liter of paraffin in a rural Kenyan home. We will continue to follow this story closely. For now, this has been your deep dive into the oil crisis shaking the world and Kenya. Subscribe to Kenya News Update today for continuing coverage. Thank you for watching.